WhiteFiber reported before the bell this morning, and the stock is up 18%. Revenue of $28.8 million, up 54.5%. Loss per share of 39 cents against a street bar of 45. A beat on both lines. And then here's the thing. $12.3 million of that revenue is a fee that a customer paid in order to get out of its contract.
It is called a termination fee, and it sits inside the cloud services line. Remove it, and the quarter produced $16.5 million of revenue. That is below the same quarter a year ago, and it is well below the March quarter. The company does not hide this. Its own management discussion says the lost monthly GPU revenue was substantially offset by the termination fee. Those are its words, not ours. And 8 weeks after quarter end, that fee had still not been collected in cash.
Set the tape first, because the timestamp tells you which session is the reaction. The 10Q was accepted at 7 o'clock in the morning Eastern Time. That is 2.5 hours before the opening bell, which makes today the reaction session and not tomorrow. There is no 8K for this print at all. Tuesday closed at 24.22. Today, 28.58, up $4.36.
And notice where an 18% day actually leaves you. The 50-day average sits just under $30, so even after the pop, the shares are still trading below their own recent trend. The closing high in June was almost 45. This is a stock that ran from roughly $11 in March to 45 in June and then back into the high 20s. For this name, 18% is a fairly ordinary Wednesday.
Quick thing, then back to the numbers. Everything I do here, you can learn to do yourself. And there's over 5 hours of audio and video in the Charged Alpha app. Every concept reinforced on real stocks with real metrics. Interactive labs on real companies. Quizzes that make it stick. And Storm Chaser, play through real market crashes. It's free to start. No ads, no account. Search for Charged Alpha on the App Store or Google Play, same name as the channel. And subscribe. One company honestly valued every episode. So what is WhiteFiber? There are two businesses. The first is colocation, which means it owns data center buildings and sells space, power, and cooling to customers who bring their own machines. The second is cloud, which means it owns racks of NVIDIA processors and rents the computing capacity out. It came public last August, carved out of a Bitcoin miner called Bit Digital.
And that carve-out is the most important structural fact in the whole story. Bit Digital handed over the business, took shares in exchange, and still holds close to 7/10 of the company. So the parent is the controlling shareholder. The parent is also, as we will get to, a lender to it. And the chief executive holds the same job title at both companies and may spend up to 30% of his time on the parent. Fewer than 100 people work here in total.
Now the print itself. Cloud services, $23.8 million. Colocation, 4.7. Cost of revenue, 11.7. Depreciation, 6.6. Then a $5 million write-off because in June the company decided to abandon a software platform it had built internally and wrote the whole remaining value off. Overheads of 14.8, which leaves an operating loss of $9.3 million.
And I would put that operating loss on the wall. $9.3 million this quarter, $9.2 million in the same quarter a year earlier. Revenue supposedly grew by more than half, and the operating line moved by $99,000. That is what it looks like when the growth is a one-off fee, and the cost base underneath it is growing for real. Below that line, something appeared that was not there last year at all. Interest expense, $6 million of it on a business that a year ago had no debt whatsoever.
Let us do the arithmetic in the open, because everything turns on it. Reported revenue, $28.8 million. The termination fee, $12.3. What is left is $16.5 million earned from actually serving customers. Against 18.7 a year ago, that is a fall. Against 21.9 in the March quarter is a fall of roughly a quarter.
And it gets stranger. After the quarter closed, the fee was renegotiated upwards from $12.3 million to $15.7. The filing states that the amended amount remains outstanding as of the date of the report. So the revenue is booked, the earnings beat is built on it, and the money has not arrived. It is owed by the customer that just walked out. That customer was the original one, signed in 2023 for more than $50 million a year. $2.2 million of its receivables were written off as bad debt.
Right. Now let me argue the other side properly, because there is a genuinely good story in this filing, and it deserves the airtime. WhiteFiber has just over $1 billion of signed contracted revenue that it has not yet delivered. Accountants call that remaining performance obligation. $933 million of it is colocation. It is under contract, it is long dated, and it is real.
The centerpiece is one agreement at a facility in North Carolina with a company called Nscale. 10 years, 40 megawatts, and the initial service order alone is worth roughly $865 million. Electricity is billed straight through to the customer, so WhiteFiber is not carrying the power price risk on it. Billing begins this quarter, which means it contributed precisely nothing to the numbers we have just been through.
Here is a question worth asking about any company that burns cash at this rate. Who is paying for the build-out? And in this case, part of the answer is genuinely unusual. The customers are paying for it. Deferred revenue on the balance sheet has reached $143 million from about $80 at the start of the year.
Which is to say customers have handed over $72 million in advance for services that have not been performed yet. That is 2.5 times the entire cash balance. And it flatters the cash flow statement enormously. Operating cash flow for the half looks like a positive $89 million, but $63 million of that is simply the increase in deferred revenue. It is a prepayment, not a profit. The other part of the answer is Bit Digital, which opened a $100 million credit line to its own subsidiary in May.
So let us look at what the cash actually did. Capital spending across the half was $344 million. Operating cash flow, even flattered by those prepayments, was $89. The difference is a free cash outflow of roughly $256 million in 6 months at a company the market values at $1.1 billion.
And you can watch it happen on the balance sheet. Cash fell from $114 million at the start of the year to $56. Property and equipment nearly doubled to $651 million. To be fair, that is exactly what building data centers looks like, and the assets are real. But working capital flipped from positive $85 million in December to a deficit today. The filing uses that word itself, and there is debt maturing inside the next 12 months.
Now there is one transaction in this filing I want to spend a minute on because I have not seen anybody discuss it anywhere. In January, the company raised $230 million of convertible notes at 4.5%. Net proceeds after fees, $222 million. Perfectly reasonable financing for a company building out capacity, and then it immediately spent $120 million of it.
On its own shares. It bought what's called a zero-strike call option. It paid $120 million up front for the right to receive $5.9 million of its own shares in 2031, with no further payment due. Functionally, that is a prepaid buyback. 54% of the money raised in January went into its own stock rather than into a data center, and that is why shareholders' equity fell by $145 million on a $27 million loss.
Let us price it then. 38.6 million shares at $28.58 gives you $1.1 billion of equity. Add the debt, subtract the cash, and enterprise value is about $1.36 billion. Trailing revenue across the last 4 quarters is $94.5 million. So you're paying a bit over 14 times sales.
Except we have just spent 10 minutes establishing that $12.3 million of that trailing revenue is a breakup fee. Take it out, and the denominator is $82 million, and the multiple is above 16 times. The bull answer is that you should be looking forwards rather than backwards, and consensus carries $266 million of revenue for 2027. On that, it is 5 times. But that requires revenue to roughly triple from here.
This business has no earnings and deeply negative free cash flow. So a conventional discounted cash flow on today's numbers would be theater. So we do it the other way around. We ask what has to be true in 2029, and separately, we ask what the contracts that are already signed are actually worth. Start with the second question, because it is the more interesting of the two.
$933 million of colocation is under contract. At the cash gross margin that segment earned this quarter, that book generates something like $588 million of gross profit, but spread over 10 years and more. Call it $55 million a year. Now subtract the company itself. Overheads excluding stock compensation are already running near $45 million a year, and the cash interest on the notes is another 10. The entire signed book roughly covers the cost of being a public company.
Which is not a criticism of the contracts. It is a statement about the price. The bull case for WhiteFiber is not the $1 billion that is already signed. The bull case is the 1,500 megawatts of projects the company says it has under review, none of which is contracted and none of which is funded.
And the bear case is simply what is sitting in front of us. 7 customers in total. One of them was 63% of revenue in the first half. 3 orders were discontinued during the period. The French contract, worth over $160 million, slipped from July to September, and its project financing is still described as a term sheet with material terms unresolved. Enormous fixed commitments, and a very small number of counterparties on the other side of them.
So the call. Our base case fair value is $16.50 against a close of $28.58. That is about 42% below the price. The verdict is a void with conviction of 3 out of 5. And the honest reading of that 3 is this. We think the assets are real, and we think the multiple is wrong. Those are 2 different levels of confidence.
The number that persuades me is the bull case. Give it $520 million of revenue in 2029 45% cash margins and a 13 times exit multiple, and we arrive at $29.15. The stock closed at $28.58. You have to believe our entire optimistic scenario in full simply to justify what you are paying today. That is not a margin of safety. That is a coin flip with a data center attached.
What would change our mind specifically? One thing above all others, and it arrives in about 11 weeks. Colocation revenue in the September quarter. It was $4.7 million this time. If the North Carolina site ramps the way management says it will, that line should be heading towards $20 million. If it gets there, our model is wrong, and we will come back and say so.
2 others worth watching. First, whether that $15.7 million termination receivable actually turns into cash, because at the moment it is revenue the company has recognized and money it has not got. Second, whether the French project financing progresses from a term sheet into a signed agreement. And third, honestly, the customer count. 7 becoming 12 would change the risk in this business far more than any single quarter of revenue could.
Against Wall Street, the average target is 32.33, so the street sees about 13% upside from here, and the ratings skew clearly to buy. Needham, Beat, Roth, B. Riley, and H.C. Wainwright are all positive. Barclays moved to equal weight in July, and Cantor has been neutral since May. So it is not unanimous, but it is a long way from where we are.
And look at how thin the panel is. 5 estimates for this year, 3 for earnings, and exactly 2 for 2028. Consensus has $127 million of revenue this year against 51 actually booked in the first half, which requires a second half 50% larger than the first. That is the North Carolina ramp entirely. We are 49% below that average target, and we own that. Our disagreement is about the multiple, not about the contracts. This analysis is compiled with frontier AI research models, and all scripts are AI generated. This is for informational and entertainment purposes only and is not financial advice. Charged Alpha does not have a position in any stock discussed unless explicitly stated. Do your own research before any investment decision. Data sourced from FMP and SEC Edgar.